Hi everyone, thanks Charles. I thought I'd just start today by, I guess, talking about what I'm seeing more broadly. As Toby mentioned, I specialise in helping clients with ethical investments, but I'm finding that especially during the bushfires, more and more advisors were reaching out to me and finding that they had clients that were asking them about what their portfolio was ultimately invested in and what the impact of climate change was to that portfolio, but also what was that portfolio doing in the world? Was it actually contributing to higher temperatures and more extreme weather? The other thing I've noticed, particularly in the last couple of years, is more and more people in the general public starting to connect that their super is actually their money, and that they want to engage with it. They want to check the fees. They want to understand ultimately what they're invested in. And they're asking questions of their advisors. So one advisor contacted me last year because he had a long-standing client who came in and was very concerned about Westpac and their allegations of being involved in terms of money laundering and potentially child trafficking. So I think there's a range of issues that everyday Australians care about, and it's interesting to note that the Responsible Investment Association has some research that recently came out that showed that the majority of Australians, so around 9 out of 10 Australians, expect that their money already will be ethically invested. So it won't be invested in things causing harm, and it will be invested in industries that are growing and industries that they see as the future. So things like renewable energy and companies that have a good corporate responsibility, and so are doing the right thing by people and the environment. For those reasons, I think ESG and ethical investment are more front of mind, and definitely, as Leah pointed out, you can see the funds under management are growing accordingly. From an advisor perspective, I think it's really important to consider your response when clients actually do bring up these issues. Because, as we all know, as people, we all like to be heard and respected. And so being able to have that conversation with clients when they say, I'm concerned about, say, gambling, and I'm concerned about investing in Crown casinos, or I'm concerned about investing in fossil fuels, actually having a bit of knowledge and being able to lead that conversation with the client. So some of the things that I think are really relevant is to look at your fact find, look at your documentation, and perhaps actually asking some questions around some of those key issues that Australian consumers do care about. And then with that information, digging a little bit deeper. So how far do you take a particular ethical issue? If we're talking about fossil fuels, is it just an investment in fossil fuels that they're concerned about? Or are they also concerned about banks that provide the key funding for those fossil fuel ventures? So I think around that, you can shape that advice. And again, coming back to, as we all know, acting in the client's best interest and framing it around what the client cares about, and file noting accordingly. The other thing I just thought I'd briefly touch on is the regulatory landscape. Means at the moment that if we're talking about, say, climate issues, they're material. So ASIC, APRA and the RBA have all come out saying that climate change is a material issue that needs to be taken into consideration. So I think it's really important as advisors to upskill, to understand the impacts of climate change on portfolios, and to really see how that might impact our clients' financial futures in order to be good fiduciaries. So at the end of the day, to act in the client's best interest. One of the key things I think is worth looking into with that is also looking at the underlying holdings. So as we've seen today, Australian Ethical have one approach, American Century have another. Lots of different fund managers and super funds have different approaches to how they actually screen or how they implement their ESG analysis. I think one of the key things to actually look at, so contact the fund manager, ask for further information on that process, but to also look at the underlying holdings, because that'll tell you how ultimately it's implemented. Looking at so one of the key issues is many funds have a threshold. So they'll say they won't invest in tobacco as long as it's less than 5% of a portfolio. And it's key to draw out some of those thresholds and talk to the client and say, are you fine? Are you okay with that? Or do you want a zero tolerance, say, to tobacco, as an example? So I might pass it on to Leah now to conduct the Q&A section.
Thanks so much, Mary, and thank you, Charles. So we've given you sort of three different perspectives, the rise and the sort of domestic piece, the global, and then the advice piece, which I think is really important from a practical point of view. I'd ask everyone at this stage, we have a Q&A panel. If you wanted to type in any questions, please feel free. We're happy to answer them now. We've got about sort of 10 more minutes before we hand over to Paul. So while we're waiting for some of those questions to come through, I might just open up a couple of questions that I have here. Charles, I think you bring a really good global perspective. How do you think the regulatory landscape around responsible investing is changing either here or overseas? And how are managers, mainstream managers, going to have to evolve, or are they changing to respond to this sort of changing landscape?
Just off mute. Thank you, Leah. I think that's a great question, because one of the problems that investors have had to date is there isn't a clear benchmark of what ESG investing means. And we've seen different attempts by different people, different organizations to try and provide a bit of clarity, a bit of consistency within that. So we've had things like, I mean, a long time ago now, but the UN's Principles of Responsible Investing, which was really, again, a voluntary disclosure framework that was launched in 2006, and it covers a huge amount of money, assets under management today, but it was really just a commitment. We've had the SASB, the Sustainability Accounting Standards Board, launched in 2011, which has really tried to bring consistency when people are talking about measuring greenhouse gas emissions, energy usage, water usage, etc. And that's seen a dramatic take-up. So if you're looking at key companies in the US, maybe 90% now adheres to those standards. And then more recently, we've had the 17 Sustainable Development Goals from the UN. Again, these are helpful in providing mapping or an approach to for investors to consider. So the regulatory landscape is becoming more aware. It is becoming a little bit more helpful, but sometimes this isn't always consistently met with governments. So for instance, we had the Paris Climate Agreement, and we've seen some important players since withdraw from that. So I think it becomes even more important for the investment community to take action. So you can make a difference by allocating capital to low carbon investments. You can put pressure as an investor on governments to enact change. So I guess a short answer to summarize my answer, that regulatory change is happening, and as investors you have to be mindful of those developments. They're moving in the right direction, but they're still not quite there yet in terms of broad consistency across benchmarks, etc.
Thanks very much, Charles. I would echo that you are seeing movement in this space at the moment. So you're seeing in the EU, they're bringing in regulation for investment managers to have to consider climate risk in their portfolios and climate commitments of companies. You've seen Ireland ban all exposure to fossil fuels, and you've seen New Zealand actually regulate against exposure to lots of different controversial sectors in their super funds and Kiwi savers. So, and you've seen the first landmark case against REST by a member for lack of commitment of climate change, which will be going, I think it was due to be heard in about July, but we'll see what happens from there. So thanks, Charles. We do have a couple of questions that have come through. There was one in particular around COVID-19, and I think, Mary, this might be one for you, but certainly we can jump in as well. From the client's perspective of investing, has there been any questions or changes, I guess, you know, what's been the response by your clients in terms of what they're looking for through this COVID-19 period?
Yeah, I think it's an interesting one. My clients, because there is that tilt towards having a positive impact, a lot of my clients do have exposure to healthcare and other services. So I guess that gives them not only a little bit of financial stability, although healthcare has been hit, but more broadly, for them, it's a, you know, they can feel good that they're contributing to, say, you know, with an investment that's making rubber gloves, or has exposure to helping address the crisis that we're currently facing. And I think more broadly, looking at, you know, what can their money do? Can their money make a positive difference, particularly when people are feeling like they're a bit stuck and they're feeling like they don't know how they can actually help. So they're feeling helpless. And that was a similar feeling with the bushfires, in that a lot of people felt like, what could they really do when they could see much of Australia burning and people losing their lives and their livelihood and their property. And one way that they felt that they could actually take an action and make a difference was to move their investments or move their super to something that wasn't contributing to climate change. So some of the conversations I'm having with my clients is, you know, how are they positioned, and do they want to continue to kind of have that positive difference, that financial return, as well as that social return, and that feeling like they're actually they're not contributing to problems that are around. In terms of inquiries and new people that are approaching me, again, I guess it's a similar theme, in that people want to be part of the solution, especially at times of crisis. We want to be on the right side, I guess, the right side of history. So,
yeah, perfect. Thanks, Mary. It's interesting from a super fund member perspective, because we obviously run a super fund as well as having the managed funds available via platforms, and we've actually seen certainly a little bit of a retraction in terms of the numbers of members that we would normally have coming to us, but they're still quite high record levels compared with previous years. So I do think that some of the things that are occurring in the world, even post bushfires, are sort of driving that that inquiry from clients. I just wanted to pose another question really quickly, and I might answer it and then hand over to Mary. Brendan Jones asks, it can be difficult to obtain exactly how different products and managers operate, how they approach different things like tobacco gambling. Is there somewhere to go that helps advisors work this out, and what's being done in the industry to standardise reporting? I would answer you, Brendan, by saying we've done a lot of work around this, and this is why we've actually decided to have take, I guess, a really proactive role in terms of education of advisors. It can be complex, it can be confusing, and you do really need to get down to the nitty-gritty of a portfolio to understand exactly what a fund manager is doing and how that will line up with your client's expectations. But certainly RIA are doing a lot and have populated their website with a lot of information, and you can actually look for particular exclusions, and you can narrow down fund managers. We have groups like Morningstar working with Sustainalytics, and I know that Longsek's looking at doing some more in this space. And in fact, Praemium, we just launched an SMA with them a couple of weeks ago, and they're looking at, they're actually really implementing some quite strong exclusions that advisors can start to implement on their portfolio. So yeah, I might hand over to you though, Mary, because you've been doing this longer than any of us.
I think it's unfortunately, where we're at is that there are lots of different approaches, and that just ultimately means that it's part of kind of doing your due diligence to really understand the product and how each product screens. I'm of the opinion that it's good to have lots of different approaches, although it can make it a little bit difficult to navigate. It means that you're more likely to find a product that really suits the client that's sitting in front of you. So there might be clients that are really passionate about, you know, being able to give money to charity through an investment, and there are products out there that don't have strong ethical screens with their process, but the profits from the fund managers essentially go to different causes. On the other end, there are people that are really passionate about that screening process. So they don't want to make money off causing harm and then give it to a charity to address that problem, on the other hand. and there's all sorts of things in between. So there might be a client in front of you that likes to have a beer on the weekend and is quite comfortable investing in alcohol. There might be another client who has had a parent who is an alcoholic and doesn't want anything to do with alcohol, including doesn't want to invest in supermarkets that that might sell alcohol and might give discounts for bulk purchases. So I think around that, it's there is a bit of work to it, but again, that's really like any type of investment, really understanding whether it's a growth manager versus value, and that actual individual manager, what's their approach to investing. And as Leah said, there are some resources out there. The RIA resource is Responsible Returns. So if you go to Responsible Returns, you can search certified products where RIA has certified that they are, performing their ethical process according to how they say they will in their product disclosure statements. So I think that's a really good resource to tap into.
Thanks so much, Mary. We're almost out of time, so just wanted to start to wind it up. There was a couple of questions around ESG investments and the cost of those. I'm assuming that cost and performance is a concern. I might just finish on the note that we've been doing this for over 30 years. We know that there's no cost to performance. Our Australian Shares Fund has received a number of awards recently against mainstream managers. Even through this period, we've performed. Obviously, everyone's going to suffer through this period, but we've performed relatively well against the indexes and have started to bounce back with the markets as well. So we would certainly say that there's no sort of cost to performance from investing ethically or responsibly. With that, I might thank our panelists. Thank you so much, Charles, and thank you, Mary. Thank you to everyone that's attended this morning. I hope it's been useful. Please reach out to us. You don't need to know everything about responsible investing. Please let us know if we can help you out in any way. Thanks, Toby.
Thanks, Leah.